It's an industry worth trillions, and it has companies in it that will decide the next wave of jobs in the world. It also will decide the apps that will be on your phone. And lastly, it will determine what all of our retirement accounts will look like 20 years from now. Most people think that they understand this industry because they have watched Shark Tank or they've heard the word unicorn. The truth is, nobody knows how this industry works. It's not the stock market and it's not private equity. I'm talking about venture capital. This is the engine behind the best and most generational companies over the last 30 years. And the goal in venture capital is to sign one of these. This is a term sheet. If you are a top founder, you will sign tens, potentially hundreds of term sheets in your future. But today, I'm going to show you everything you have to do before you sign one of these. Capital is more available and more misunderstood than ever before. What I'm going to show you today is exactly everything that happens before you sign the term sheet. You need to know where the money comes from. Follow along.
Yeah, yeah, we on top and we can't stop. Let's go. Yeah, 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 we on top and we can't stop.
Okay, first thing we're going to talk about is where the money comes from before it's even in the bank account of your investors. This starts with LPs. LPs are limited partners. These are the people who write big checks into venture capital funds. So, who are these people? They're in two groups. So, LPs, right? And then they're in two groups. Group one is high net worths. High net worths. That's group one. Group two is institutions. All right. High net worths makes a lot of sense. These are just wealthy people. Wealthy people, right? This can be like families. This can also be just like founders, etc. Very simple category. These people write check size between kind of like 100K all the way up to, I would say, like $2 million. That's their check size. Okay, so you might be thinking to yourself, how does a firm like Harlem Capital manage hundreds of millions of dollars? Or how do other firms manage billions of dollars? That is from institutions. Institutions are made up of typically three categories. You have foundations, which are kind of like nonprofits. You have endowments, and then you have pension funds. These are the biggest pension funds. So, a foundation. A foundation can be anything. It could be a foundation that's focused on healthcare. It could be focused on inner city work. One of our LPs is a foundation that is like trying to solve cancer and trying to like make it to the next level in healthcare breakthroughs. Endowments, that could be universities. It could be like Duke University, Georgetown University, one university that's really interesting right now is Villanova. Villanova is going to shoot up in their endowment because people are going to continually give. Why? One, because they won all those championships recently, but also because many of those folks are playing for the Knicks and they just won the first championship in like 50 years. So endowments being able to leverage the capital that they fundraise or capital that they invest so that they can build more facilities for other students. And then pension funds, which is the biggest, are exactly what it says. These are pensions for people, typically for the state or for the city. So you can have the state pension fund of New York City. You can have the California pension fund of teachers, like all these different things. And these are massive. I'm talking about like 100 billion plus dollar funds. These people write checks this size, 10 to 100 million plus. So, what is the goal of these two things? This is where we're trying to understand as a founder, why is what the LPs want and where that money comes from important to me? The goal for these goal is 3x returns. So, any check that a high net worth or institution writes, they want to see 3x return on the money over 10 years. So what does that mean now for you as a founder? That means for you as a founder is that investors have a boss. Their outcome to their boss of looking good is to return 3 times their money over 10 years. So if I have a $100 million fund, I need to return 3 times that and return it to my investors so that I can continually raise more funds. And so my opinion to you as a founder is if you understand what the end goal is of an investor, you can reverse engineer of how you can help them get to that end goal. That's the same thing we do as investors to LPs. We know that LPs want to potentially sometimes have impact. They want to invest in a certain city. They want to be in certain sectors and they want these returns. My job is to come into the meeting and pitch them on how we can get them here and also make them feel good along the way. It's the same thing with a founder. You want to pitch me on how I can get here and how we can enjoy the relationship at the same time. Let's do this one more time. Okay, so we just figured out that LP's number one thing that they want is returns, 3x returns. And you could potentially think that investors just want 3x returns, but that's over 10 to 12-year time period. Now, venture capital funds raise a new fund every 2 to 3, maybe 4 years. So there is a difference in between chasing 3x returns and raising your next fund. That's what I'm about to tell you right now. So, what VCs want? Okay, so VCs do want 3x returns, but they want those 3x returns to come 10 to 12 years later, which makes typical sense. So in the meantime, what VCs want is this. We want markups. We want brand affinity. And the third thing is stronger reputation. Okay, what does markups mean? Markups are literally just founders who can fundraise capital fast. So if I invest in your company as a seed company in June 2026, and I believe that you could potentially, by the end of 2026, raise your next round, potentially I'm really interested to invest in your company versus someone else's. Because when you mark up a deal, which means that if Harlem invests $3 million in the seed and then XYZ venture capital fund invests $20 million at a Series A, the valuation in my company or the valuation of my dollars goes up. So this is the biggest indicator for LPs to understand if you can choose companies the right way. So realistically, investors want to invest in founders who can fundraise really well. Typically, that means that the business is growing fast. That means that they can recruit great talent. But realistically, it's like, are you an amazing storyteller in a category that makes sense for a lot of interest from other investors? I know it does not make full sense, but like this is what VCs want. We want to get our deals marked up because markups are the only thing that we can show before we have true returns. Okay, number two is brand affinity. This really means that if I invest in your seed, I want an even better reputation fund to invest in a Series A, and then I want that to compound every round. I want blue chip names, the Sequoia, the Andreessen Horowitz, the Benchmark, the Union Square Ventures. I want them to invest after me because that does make me look like a smarter picker. So, how can you, as a founder, think about the brand affinity overall? My opinion, like you could start networking with some of these firms super early. You can start speaking to founders who have been backed by these firms very early as well. And you can really figure out your way to be in the know of what's going on. So, really understanding how brand affinity works from other investor standpoint when you're fundraising capital. Now, the last piece here is just like it can sound similar to brand affinity, but realistically, it's just we want to invest in people who make us look smart. When I worked way back in the day in the creative industry, I had a boss who told me we want to look smarter, become famous, or rich. Like that's the categories you want to do to bring on new customers. For this perspective, we want to look smart. Investors want to look smart. So, how can you build a company in a space where an investor looks smart? So, think about how you can come and execute on these three things. What am I not saying? I'm not saying build another accounting software. I'm not saying build another simplistic consumer company. I'm saying think about something that's very cutting edge, that really hasn't been done before, that seems super tough, and position yourself as the best person and team to execute on that plan. All right, guys, I have an honorable mention. This can trump everything that I just said. And this is speed and velocity. No matter what your company is, if you're pushing product faster than anyone and your revenue is growing faster than anyone, I'm talking about 1 to 3, 1 to 5 million in revenue, or even if you're later stage, you're about 10 million in revenue and you can grow 5x in a year, realistically, investors don't even care what you build. They believe that you are a company that's going to get marked up. They believe that you are a company that are going to get other firms that are even better to invest in. And they believe VCs will be have a stronger reputation and look smarter from investing in a company like yours. This actually solves all problems, which is basically winning. If you can win your industry, VCs will invest. Okay, another thing that you need to know as a founder before you sign your term sheet is how VCs can add value to your company even before they invest. VC value add. All right, there's a funny joke going on in the industry around VCs adding zero value. Most VCs add zero value. Even in one of my past videos with Dion, one of our founders, he always talks about VCs typically never add value. So, what I want to caution you about is that most VCs are going to sell you on things that they're not actually going to do. So, what is the solution to this? My opinion is you should put a venture capitalist to work before you fundraise. What is the examples there? So, number one is intros to experts. So if you are in the AI industry and you're looking for to do new research and do this, that, do that, and another, ask the VC if they have introductions to PhDs, to people who work at Stanford or Berkeley, people who might work at OpenAI and Anthropic, etc. Maybe you're in a vertical industry, you're in assisted living. Do they know people who do private equity in the healthcare space? Like your job is to put people to work before they invest so that you understand their work style, you understand their speed, you understand their velocity and how much they can help. Number two thing is can be hiring. So intros to hires. The third thing can be like intangibles. for Harlem Capital, one of our things is we believe that we've built a brand leader in venture capital in less than two funds. We believe that we can build you into a brand leader in your industry in less than like 1 to 2 years. And so we're going to give you our entire creator stack, our videographer, our photographer, the people who can do your launch video, brand positioning, if you need to do clipping, user generated content, anything. You need people to do your thumbnails and titles on YouTube. We can set you up with that. So like also ask VCs, what are their intangibles? Tangibles, you can also call this superpowers, right? And so your job is to actually turn the table on a VC. You are interviewing them. This is a two-way street. It takes two to tango. You already know. So make sure you're doing these things. And then maybe one last thing I would do is references. References. Your job is not to only do references on that firm, but also to do a reference on that specific partner who's trying to invest in your company. You have to realize this is a marriage. When you let an investor invest in your company, it is literally going to be a 10-year partnership. You do not want the wrong person attached to your hip for 10 years, and they legally have rights to do things that can be detrimental to you and your company and all your employees. So this is very important. And I have one last thing on the subject. I think before AI, these things were really good. Very easy to do. You just ask people. But I think now with AI and with Claude, you should create your own project on Claude, and you should do find a person or do a research deep dive on a person. And so any of the investors that you are speaking to, you should have a project with their name, and Claude or OpenAI, ChatGPT should do a deep dive on all their content, deep dive on anything that is like on the internet about that individual or partner, and then ask them what are the pros of working with this firm and this partner, what are the cons, and then realistically you can even force rank. Let's say you're talking to 10 different VCs, you can have the AI force rank who is the best firm and then who is the best partner, and that can take literally less than 30 minutes. So I do think that this like AI search and ranking is something you should do for your investors, something you can do for new hires, something you can just like even just do with how you want to do your like product roadmap at your company. Like leverage AI as a co-pilot. But I think it's really important to understand like if a VC's value add is really good and if you should choose them for this 10-year journey.